Hi and welcome to FinTalks, a chat with FinanceMalta. This is Matthew Bianchi and I'm the Deputy Governor of FinanceMalta here. Today with our guests Elizabeth Carbonaro from MIMA, the Malta Insurance Managers Association, and John Tortell, who's a broker in the market, active in the PCC world. Why PCCs? Because today's chat is going to be about PCCs and innovation around PCCs. Just to start off, the big innovation for sure about PCCs is simply the fact that Malta has managed to dovetail, the PCC legislation, protected cell company legislation, into our mainstream legislation, mainstream company law and mainstream insurance law. We are, probably the only jurisdiction in the EU at the moment with PCC legislation, and Liz and John will tell us a bit about this later. And what's fascinating is that we're probably the only jurisdiction in the world that has managed to bring PCC legislation in, both for insurers as well as for intermediaries. And intermediaries, you're dealing with the broker space and you're dealing with the insurance managers. And the truth is, if you look at the list of licensees on the MFSA website, you see that we actually have each of those. So lots of insurance undertakings, and Liz will tell us a bit about that soon. A few brokers and one or two insurance managers. I suppose, Liz, over to you to tell us a bit about, where the innovations lie in the PCC market for insurance undertaking.
Thanks, Matt. I think if we had to look at it from an innovation, starting off with that, the PCC is like any other insurance entity. One of the main differences, though, is that the cells themselves can act as mini insurance companies. So that effectively means that the cell itself is a insurance standalone vehicle on its own, not necessarily from a legal point of view, but definitely from an operational point of view. So this allows investors to utilize a structure in order to have different entities attaching onto that same structure. So as an example, you can have a PCC structure which can have captive business. So you can have one cell which is writing a captive business of a particular group, and you can have another cell which is writing affinity business or direct writing risk. So you've got an accumulation of different types of insurances within a similar structure.
And each with different interests.
With different interests. That's the main benefit, that you have your central core, which is the main provider from a regulatory point of view and a legal point of view, and then you've got the different cells which sit below the main item. Where do we see the biggest benefits? One is clearly we are working in a Solvency II regime. It is quite robust. It's a very robust regime, both from a capital point of view and from a governance point of view. So the biggest benefit from a governance point of view is that the cells themselves can rest on the robustness of the core. So things like compliance function, like risk management function, like actuarial function, sit within the core, which allows an element of expertise to then be spread along the various cells. The other main aspect is the capital. From a capital point of view, the PCC as a whole needs to be solvent under Solvency II, clearly. The cells need to be solvent or tend to be required to be solvent in their own right. But what that means is they do not actually need a minimum capital, whereas within Solvency II there is a requirement for a minimum capital.
Which is why you're calling them mini insurance
Which is why we call them mini insurance companies. Where is the innovation and what are we seeing at the moment? So at the moment, from an overall insurance market point of view, we're looking at a hardening market, we're looking at a reduction in capacity, we're looking at reduction in D&O, we're looking at reduction in PI kind of covers, even hardening market in property. So what this means is we are looking at, and we're seeing a number of groups that want to utilize a cell for their captive business, and it allows them, the flexibility of the cell allows them to be much more cost effective and more cost efficient. In fact, if we look at it both from a Malta and I think even offshore, we're seeing cells really taking up a lot of the captive space. Another area which I think is probably where there's an innovation, certainly from the European point of view, and certainly not from an offshore point of view, is the idea of utilizing cells for insurtech type affinity style businesses, where you have simple policies, mobile handsets, extended warranty, pet insurance, things which aren't necessarily complex, where they sit perfectly within a cell because they are relatively short tail, where the policies themselves are structured simple policies, and where therefore the cell structure is ideal because again it is much more cost effective. The cell owners are able to benefit from the know-how within the core itself, and the cores will tend to be funded either by the big brokers, by the the Marshes, the Willises, the Aons of this world, along with a whole lot of other different groups, and they're able to benefit, take advantage of the economies of scale.
So if you look at that sort of as an incubator for a mini insurer, do you see things evolve and do they
Yes.
eventually become insurance
Yes,
companies?
in fact, that is another thing which we are seeing. So they do act as an incubator because you might look at and say, I want to step into the idea of a captive, step into the idea of an insurance company. You might not necessarily have the know-how, so you're leveraging off that experience, and then 3 or 4 years down the line, you might decide to convert that cell into a standalone company. And I mean, we have actually seen that in Malta. So we have seen a couple of cells which have actually, they're no longer cells, they're now operating as standalone insurance companies. And that again is also, I think that's pretty innovative because it allows people to gain the experience. It allows the shareholders to understand what actually having an insurance company or a captive is. And it gives them the flexibility to expand their own strategy, independent then.
So you sort of dip your toes and then you can go.
Exactly, dip your toes in.
Which you mentioned the insurtech market. I mean, is that something that's caught on or is catching on or something we're anticipating will happen in this sense?
We're seeing interest in that. When we talk about insurtech, we're also talking about the ability to to write policies across the internet, the facility, and the cell is perfect. It's perfect for that. Where you've got the systems which are almost outside of the PCC itself, and the distribution is then done via the systems which would belong in most cases either to the shareholders or to partners of the shareholders.
And presumably the people looking to set up these cells don't have the insurance expertise, so they feed off.
Exactly. They will not have the insurance expertise, or they might have the insurance expertise, but they might have a small portfolio, for example, and therefore they are not ready. The return on capital of investing, the minimum required maybe doesn't make it financially feasible. So there is also that as well. It's a mix of both. Obviously, as they grow, then, clearly then the capital is required even from a cellular point of view. But it does allow a stepping stone in 2 ways. one, from a capital, and 2, from an expertise. John, maybe if you want to give us an overview from the intermediary.
In the intermediary sector, the uniqueness is even more accentuated because Malta is probably the only country in the world that included intermediaries in the PCC legislation. There's no other domicile.
That's probably the single biggest
the single
innovation, 'cause
biggest part of the law that is unique to Malta and unique to the model. Because at the end of the day, the cell relies on the core for its accounting, compliance services, internal audit, passporting, also as one legal entity. So the substance does retain and remain in Malta. And also the underwriting facility is also now being used in Malta. And as you said before, with technology the way it is, today underwriters and clients can actually talk together via the cell on an IT platform. So, the IT actually gets people into more of a hub concept.
How does the model vary from your insurance model though with brokers? Because presumably a broker is intermediating, so there's more face-to-face contact, no? So how does that change from the insurer?
In fact, the owner is involved in mainly that aspect also, where brokers are seconded from the mother company to operate and give some advice to clients in the cell concept, which is mainly more than direct consumer contact. It's more wholesale broking contact, broker to broker.
I see. So the sell model works better when it's
Yes.
broker to broker than broker to consumer.
Yes, yes.
I see.
And also in risks that are more commercial to marine, high-end, large risks than motor risks, personal lines risks.
So would you describe it as sort of almost a plug and play model where people can come with their business, plug into your model, and then they can continue to
Yes.
function?
In fact, it is a plug and play model, and it worked as an example in the Brexit situation where UK brokers had small European portfolios which they needed to retain within the group, which also retained the branding, because the cell also retains the branding for the group. So you could have a cell which has an ABC.
So maybe
brand.
the distinction here, if you were to compare, Liz's model, so when you were talking about insurers to brokers, is that the broker remains a broker and plugs into you, whereas an insurer is starting afresh and establishing. He doesn't necessarily have a network of insurers. It's his.
It is his network of insurers. So if you had to move on from what John said, you could find somebody who's intermediating across Europe, or has his own intermediary somewhere outside of Malta, for example, or even in Malta, and they utilize the cell, so they own the cell as their insurer. So effectively what the cell is doing is it's giving the capacity to the intermediaries to actually take on the risk. I think that is probably the fundamental difference between an insurance PCC and intermediary
And a broker
PCC.
PCC.
Because the insurer PCC is taking the risk, and that is obviously very clear, which is why there is such a requirement for capital as well, and for the governance aspects linked around actuarial functions, risk management, etc.
What about, coming back to John, what about how sales are branded? Because if I'm a broker sitting in the Italian or in the UK or anywhere else in Europe, and I wish to set up a broker cell in Malta, and I'm branded Matthew Bianchi, presumably I'd want that brand to continue with my
Yes.
cell here.
And
How
it
does
can
that
continue.
juxtapose
It can
with yours?
continue as long as the law states that the cell has to be defined as a cell. So you have to say Matthew Bianchi cell as part of Jatco Insurance Brokers Limited,
Or any other broker.
or any other broker, who is a PCC cell. So basically, you do retain your brand, and your clients will also be able to identify you independently within the structure.
What about recognition by institutions like Lloyd's or other, big underwriters out there when you're a
Yes.
broker cell and you go to a big Generali or a big,
Yes.
AXA or Lloyd's? What happens then? Do they recognize you as a broker?
Yes, the cells are recognized by all the major insurers in Europe, including Lloyd's in Brussels, and Lloyd's of London. And I know of PCC structures that have their terms of business arrangements with all the main insurers in Europe.
So it's almost
It has been an
seamless.
accepted. It is a spin-off from the insurer concept.
Yeah.
So once they have offered, example, fronting arrangements for insurer cells, they were used to that
Yeah.
concept and are happy to use it.
I mean, I think this is the main thing to make reference to, is that it's true that Malta is the only EU jurisdiction that offers PCCs, and this is why, from a European point of view, it's very innovative. However, from a global point of view, PCCs or renter cells or renter captives are a very, very common
Model.
I mean, you've got them in the US, you've got them in a number of different jurisdictions worldwide, and they've been around for a long time. So the intermediary is taking on from that as well.
I know from the market you sometimes hear of insurance cells which are themselves then managed by other parties, so the protected cell. Do you want to speak a bit about that?
Yes, again,
or
I mean,
what-
ultimately the core will belong to one main body. Now, that main body, you can call it the primary investor, and there are certain structures in Malta where they are set up specifically as tools to assist clients of the large reinsurance brokers and brokers. So in those particular cases, they do offer the facility of either they manage themselves, so each cell has to be managed by the core owner, or there are certain others where it is a business venture, it is an investment opportunity by a set of investors, And on that basis, they are therefore more flexible vis-a-vis who manages the cells. So yes, there are some PCCs where you'll see the PCC belonging to one shareholder. Some of them even operating in Malta, so they actually write insurance policies in Malta itself. And then the cells are owned by third parties and managed by other managers in Malta. That really depends on the strategy of the core, so it's both really.
And managers, I'm talking about managers because you're here to represent the managers. Managers are effectively licensed intermediaries and can also be PCCs.
Yes, exactly. Managers are licensed intermediaries, and therefore on that basis we ourselves can also be PCCs, and there is actually a PCC structure for insurance managers in Malta.
Which again is a massive...
It is, because what that also does is via the core, it allows certain of the administrative tasks to be done more efficiently, because you really have one accounts department, for argument's sake, which is doing the accounts of the core and all the cells. So there is an element of efficiency. Therefore, it allows the managers to concentrate on those areas where they feel they have most expertise.
I think you can see the legislator was really doing its best to open Malta up to as many opportunities.
It was, and obviously one of the biggest points as well, which John made reference to it, which is the substance, the fact that the PCCs in Malta are all closely linked to companies that have the substance in Malta. So the core basically has a substance in Malta, then that also makes it much more attractive for a number of reasons.
I think one of the big underpinnings, which you can't not talk about, would be the fact that this is all possible because we can passport our services throughout the EU. So if Malta weren't part of this bigger bloc,
of course,
then the whole model would be redundant. But the fact that PCCs and insurance companies can passport across the EU is obviously a big plus. The other one, and I thought maybe Liz, you might be able to address this, would be to do with the tax. Because if I'm an investor and I want to invest in a PCC, the first thing I'm going to say is, how does this work? Will I be subject to the same company tax as a company, or will the legislator, the taxman, look specifically at my profit and loss in my set?
I think I would look, before I look at the tax, I would look at the actual dividends, because investors are after the dividend, not the payment of the tax. Okay. That happens obviously
not our clients.
No, that's based on the profits you make. But the reality is, what the cellular structure does is, each cell, from a dividend point of view and from a corporate tax point of view, are deemed to be different, which means each cell will have its own mini profit and loss account. Each investor of that cell will be entitled to the dividends from that cell. There is absolutely no cross-contamination between the cells. So you can have situations where one cell is loss-making, one cell is profit-making. The cell that is loss-making will obviously not pay tax because it's loss-making, but it can, those tax losses will be carried forward. The cell which is profit-making will then pay the tax on those profits, only on those profits. So what happens in practice is, once the company as a whole, so if you look at a set of audited accounts, you're going to look at a set of audited accounts of a structure as a whole. For tax purposes, the accounts department will basically build up separate mini P&L accounts, which are then submitted to the tax authorities, and every shareholder's taxed on the basis of that set of accounts. So again, in the same way you can have a cell making profits and a cell making losses, the cell that is making losses can carry forward, those tax losses can be carried forward. In Malta, they're carried forward indefinitely. If you're making profits, then obviously you need to pay the tax in line with the local tax requirements.
So in actual fact, even though say it's one company with segregated pockets, for tax purposes, the law is saying you look at every cell as a separate taxpayer.
For corporate tax purposes, yes, we are saying it is one company. From a board of directors point of view,
Governance.
There is one board of directors that governs and is responsible for the operations of that PCC as a whole.
In fact, each cell has a separate tax number.
Yes.
Yeah, in fact, John, I was going to ask you...
Each cell has a separate tax number and is identified individually.
Yeah. And is that true to brokers too? So even
yes,
in the
definitely. Yes.
Okay.
The legislation was obviously done under the protected sale legislation, which the benefits are granted
So
to
the
both
tax would apply
insurers
for
and
broker sales as well.
brokers and managers.
And managers.
And managers as well. And I mean, Liz spoke briefly about the accounting for a sale being separate.
Yes.
And I'm just wondering, with a broker in mind now, sort of thinking through brokers in receipt of lots of premium and then paying commissions to reinsurers or insurers, etc. How would that work?
It is the same. We have in Malta, the legislation allows for the separate accounting, reporting to the regulator, which is separate also, which has to be done separately per cell and on a consolidated basis. Therefore, everybody has to keep separate books of accounts, separate reconciliations, separate bank accounts, and even with the insurers and the reinsurers, the cells would have different accounts with each insurer. It could be quite consuming.
So would, for instance, a commission rate from an insurer, from an underwriter, be different from one
It
cell
could
to the other?
vary between different.
It's as distinct as that.
It depends on the owner of the cell, obviously, what their relationship with that particular insurer is, if it's a binding authority, if it is not a binding authority, if it's...
One thing that comes to mind, I suppose any one of you can take this, but what comes to mind is, how does the core know about the business of the cells? And, in practice, what happens? Liz.
I can answer that. In practice, what happens is it is really the core that is responsible to set up the cell. So when there is an application which goes through to the MFSA to set up the cell, and to be really clear from a local point of view, the setup of a cell is similar to the setup of any other standard insurance company. So there is a scheme of operations and therefore a business plan which goes to the MFSA. It is that business plan would first go to the board of directors. The board of directors decide or otherwise to take on the cell based on the strength of that business plan. And then it is the board of directors that will submit that plan. So they will be submitting it in line, obviously, and along with the promoter, but they are very actively involved in it. What will then happen is the PCC, so each cell can or cannot set up its own cell committee. That really depends entirely on each individual shareholder. There are
And
some.
a cell committee would be something the cell does or the board does?
It is what a cell committee would be. It is normally decided as part of the process of onboarding a cell. The cell shareholders and the core and the PCC will agree whether or not a cell committee is required. For certain businesses, it could be required. The cell committee, for all intents and purposes, is effectively a management committee. And it is that person that monitors the accounts, that would look at compliance for the cell, would look at the risk management for the cell. It is an executive committee. It's an oversight committee, and it will normally have a representative of the core, so one of the board or someone representing the board. It will have a representative of the promoter, so of the cell owner, and it will normally have a representative of the manager as well. And it is managed in that manner. So what would happen is, if I was looking at it from the way we operate, so my finance people would send the cell accounts to the shareholder, and that is one set of reporting for the shareholder to know how its business is operating. And that same set of accounts would then go to the core, and that is then discussed and brought up to the board as part of the normal discussions of any other board. And clearly the directors therefore have oversight via the report that it receives. Now, the granularity of the reporting really depends on each individual PCC. It depends on a number of cells. I suppose it depends on the risks as well,
So it's sort of consultative and an oversight.
Well, yes, because ultimately it is the board of directors that is taking responsibility. So when you are looking at, basic things like, the approval of the financial statements, it is the board which approves it. It obviously gets the approval from the shareholders as well, because they work in tandem, but it is the board's responsibility. If you're entering into an agreement, it is the PCC on behalf of the cell which is entering into that agreement, so it is the board's responsibility. The judicial representation rests with the board, and that belongs to the core.
In the case of the intermediary, the cell would also have an identified person, as we call it, as the registered insurance broker. So that person is the main person who's responsible for the local operation, but is part of the, like what you say, is part of a committee that is managing also that cell. But it does the same functions as you say, which is the compliance, the accounting. They would all be separate, which and then all dovetail and report into the court.
So really, at the level of governance, it's very similar. But then in practice, one is dealing with broking and the other is dealing with underwriting and
Yes.
management of the.
If I look at it from a cell point of view, for example, specifically for a captive cell. So let's say you've got a captive which is writing a property and business interruption policy. It renews annually. You tend to take the exposure tends to be to the larger risks. So you will have there isn't a frequency of claims. You would invariably you probably would have a cell committee, but it would meet maybe once a year, twice a year, once a year to go through the renewal, halfway through the year to go through the results and to start maybe looking at the ORSA. But unlike a normal standalone captive where you would have to have the full board meetings, where people need to fly over to Malta for substance, where there is that expectation of decisions taken in Malta, not expectation, a reality of decisions have to be taken in the country where the insurer is. With the cell, you've got a bit more flexibility because the cell is a management body. So you have efficiencies in that way as well. You can manage it a bit more fluidly than you would a normal standalone company.
John, would you like to add anything before we
Yeah,
wrap up? Because
in the intermediary sector, there's obviously a bit more advice and an advisory process. So there's more connection between the management committee needs to meet at least every quarter, and on a weekly basis. There's always that interaction with the owner of the cell because there are policies obviously always
because they're
coming
feeding
in
the know-how
and they're feeding in the know-how also in that particular sector.
Okay, thank you both for being with us this morning.
Pleasure.
And I think we've exhausted innovation and PCCs, but we'll be glad to have you again on another day if we pick another topic to discuss. Thank you very much.
Thank you very much.